Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about fixed indexed annuities versus bonds. So the information here in today's video is going to come primarily from some recent research done by Roger Ibbotson in a report called Fixed Indexed Annuities Consider the Alternative. Roger Ibbotson, for those of you that may not be familiar with him, is probably most famously known for his chart, the Stocks, Bonds, Bills, and Inflation, which shows the risk and return characteristics of the major asset classes going back to 1927. Large cap stocks averaging 10% a year, long-term government bonds averaging 5.5% a year. He's got inflation on here and U.S. T-bills on here as well. And so what he kind of outlined in this report here is he kind of took a look at some of the long-term characteristics specifically of the long-term bond category. And what he wanted to do is kind of isolate some of the performance differences between what has happened historically over the entire 90-year time period from 1927 to 2016 and contrast that to what has happened specifically over the last 10 years. And so one of the things that we can see is that over the 90-year period, long-term government bonds have averaged about 5.5% per year, but in the last 10 years, that number has actually been a little bit higher at about 6.5%, a full 1% higher. But when we look at how that return was generated, we can see that historically most of the return from bonds comes from the income or from the coupon payments of those specific bonds. But in the last 10 years, only about 3.5% of that came from the income part of the bonds, but 2.89% of that came from capital gains. And historically, capital gains made up very little of the total performance in bonds. So one of the questions that I think we want to kind of ask ourselves as we start to put together our portfolios for retirement is to think about, what type of environment are we in and how would we want to use bonds to kind of meet that retirement planning portfolio. So one of the things I've talked about a lot here as we've talked about bonds and interest rates is the movement between interest rates and the principal value of those bonds. In other words, the market value, I should say. And so as rates go up, historically, principal value or market value of those bonds go down, and as rates go down, principal values go up. And one other thing to note about this is that just like any other mechanical lever, we see some pretty big differences between the bonds that are maybe at the short end, 5 years or less, versus the bonds that are at the 30-year end of things. And just like a mechanical lever, when we're way out here at the long end, those fluctuations can be quite a bit bigger. So why we're talking about this is, again, looking at the environment that we're in. And this is a chart from the JP Morgan Guide to the Markets that comes out every single quarter. And they kind of looked at the long-term history of these interest rates going back to the early 80s, where on September 30th, 1981, the 10-year Treasury peaked at 15.84%. And then at the time this was published here, November 30th of 2018, that 10-year Treasury had dropped all the way to 3.05%. So very substantial movement down. And again, that's been a tailwind for these bonds or other fixed income instruments. As interest rates have gone down, those principal values have come up. Now, I think we need to ask ourselves the question, what is the likelihood that interest rates will continue going down versus when are they going to start going back up? And we've already seen the Federal Reserve start to raise interest rates here. They just did it December here of 2018. They're projected to do it a couple more times here in 2019, according to a lot of the Wall Street analysts. So one of the ways that we can kind of tell what the impact of these interest rate movements are going to be on a bond portfolio is by looking at something called the duration. Again, this is something I've talked about in some of the other videos here, but duration basically measures the volatility or the impact that a 1% movement of interest rates could have on a particular bond or a particular class of bonds. And so we can see here by looking at this, a 2-year Treasury, if interest rates went up just 1%, that 2-year Treasury would actually drop by 1.9% according to this chart right here. A 30-year Treasury would drop by 17% with just a 1% movement up in interest rates, and a 10-year Treasury at 8.1% there. And so you kind of get the idea there. If interest rates are going to start going up, some of these bonds could be swimming upstream and could actually lose value And so that's something definitely to think about there. So that's a report, again, from the JP Morgan Guide to the Markets. You can put that into a search engine on the internet. You could probably find that, that book of charts pretty easily and kind of get into that. And again, this is looking at what the Federal Reserve is projected to do from that Guide to the Markets. And so this is forecasting here basically that the Federal Reserve is planning on raising interest rates here according to their own estimates here several times here over the next year or two. The last thing I want to point out here is that as you're putting together this portfolio for retirement is we want to look at what is going on with some of the indexes. So one of the popular benchmark indexes for bonds is the Barclays Aggregate Bond Index. And what this chart shows, it gets a little busy, it shows two things, but it shows the blue line here with the interest rates trending downward like we've been talking about there. But the gray line actually shows the increase in the duration. So since going back from the averages, it's gone from 4.8% or 4.8 years, I should say, on the duration to 6 years. So what this is saying is that the indexes themselves have been taking on more risk in a situation where if interest rates go up, that risk is really going to, we think, come back to hurt them in a negative way as interest rates go up and some of those bond prices come down. So this is something to be aware of, and you may not necessarily own the index, but you may own a bond fund or an investment that tracks this index, and if they're tracking that index, there's a good chance that your portfolio may have also maybe taken on a little bit more duration risk with that. Okay, so now let's look at what Roger Ibbotson put together. And so what he did is he kind of created this other category and looking at large cap stocks versus long-term government bonds. And then the third category here is an FIA, which stands for a fixed indexed annuity. And he shows the long-term annualized returns of those different asset classes. Again, U.S. Stocks, large cap stocks, just under 10% a year, long-term government bonds at 5.5% a year, and the fixed indexed annuity also at a little bit over 5.5% a year. So very consistent there with fixed indexed annuities versus long-term government bonds. And again, this is not to necessarily mean that you should have a fixed indexed annuity. It's just meant to kind of show you that it could potentially, for some of you watching this, become another asset class that you might want to consider. And again, there's lots of other things that you need to consider before getting into a fixed indexed annuity or any annuity, the surrender charges, tax implications, and risk and return. So there's a lot of things that you need to kind of think about there. But he also looks at the standard deviation, and what's interesting is he looks at the minimum 3-year annualized return. So U.S. stocks had a 3-year period that they lost 27% per year during that 1927 to 2016 time period. Long-term government bonds had a 3-year time period that lost 2.32% per year over a 3-year period. And fixed indexed annuities, he put down as a 0 because typically with many of the fixed indexed annuities, and not all, some of them might have a fee that could bring that down a little bit. But in this case right here, he's showing fixed indexed annuities at a 0 because typically what we see with fixed indexed annuities is they reset every single year. So usually you participate in some upside of an underlying index, but there's also a floor. So even if that index goes negative, you're locked in, and the worst that you can do in any one year would be a 0. So he basically puts that down as a 0 and contrasts that to the bonds. And then looking at the maximum returns and actually showing that fixed indexed annuities, according to the historical returns that he calculated, actually show a little bit better 3-year time period for their best performance versus the long-term government bonds. So 27% for that fixed indexed annuity versus long-term government bonds at 23%. Again, this is not necessarily, there's lots of things you need to consider before looking at an annuity, but something to think about there. Now this chart right here, what he does is he looks at another situation. So we talked about earlier where he looked at the last 10 years. We would say that would be an above median time period for bonds historically because of where interest rates have been. But he also wanted to look at, if we're going into what he believes is a median or below median environment for bonds, what likely could happen here. And he shows the breakdown of those different asset classes. So in the environment that he believes we're going into, we might be looking at a situation where those bonds might be only averaging 1.87%, so well below their long-term historical average of 5.43%. Large cap stocks, he's got that in here too, but what I really want to point out is what he might be thinking about for fixed indexed annuities at a rate of 4.42% is what it's done historically in this type of environment. So what he's suggesting is not for everybody, but for some of you that want to look at an alternative to what's going on in the fixed income environments that are out there right now, is maybe look at one of these annuities replacing a part of that fixed income piece of your portfolio. So we talk a lot about it, and a lot of financial planners talk about this 60-40 retirement portfolio. And what that means generally is a portfolio that's 60% stocks and 40% bonds, and that seems to be kind of the mainstay that you hear and see all the time. But he looks at it and says, okay, two things. One, what if we broke that 40% up and put 20% of the, or half of the 40% into bonds traditionally, but the other half of that in a fixed indexed annuity? And he shows it what the return characteristics are in this type of environment here. So looking at the traditional 60-40, 7.6% versus a 60-20-20, bringing that up to 8.12. And then also looked at, well, what if we just replaced all of the bonds with the fixed indexed annuity? Again, not saying that's what you should do, but he looks at that and at 8.63%. So it could be an environment, and even when we look at the other above median, the fixed indexed annuity tends to compete very well with that, and even the long-term averages, where we're starting to see, very tight differences in the returns between that fixed indexed annuity and the long-term historical bonds. So that's pretty much it. So I just wanted to share that with you. I thought that was a really interesting report. I think the whole report is somewhere in the neighborhood of 20 to 30 pages, gets into a lot more detail on some different charts and numbers, but the gist of it is that looking at annuities as a potential alternative to that traditional fixed income piece of your portfolio. And again, one of the, two of the primary reasons for buying an annuity, number one, is that they can offer some principal protection if the markets were to go down. Fixed index annuity definitely kind of fits into that category. And then the second thing is that they can provide some income. So what we're talking about here, probably because there was no cost on this annuity in this study, but riders can be added to these fixed index annuities that can offer some guaranteed income or withdrawal benefits for you over the rest of your lifetime for a supplement to your other sources of retirement income. So anyway, I hope you got some good information out of that. Remember, if you like what we're doing here, hit that like or subscribe button. Check out the description below the video here for the links to some of the other videos here in the annuity series, and check out our YouTube channel. We've got a whole bunch of different videos there covering a whole bunch of financial planning and retirement planning topics. So with that, I'll see you back in my next video. Thanks.